You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. Now, let's open the playbook and get started.
Welcome into Options Playbook Radio. I'm Brian Overby, the author of the Options Playbook, and I'll be your host for about the next 10 minutes here on Options Playbook Radio. We are taping Options Playbook Radio on Wednesday, October 1st, 2025, and the markets have closed. And oh, by the way, there was a government shutdown last night. The politicians couldn't come up with a budget, so the government shut down officially at midnight last night. So, the market was crazy today. No, it wasn't. I don't understand why. The VIX actually closed flat at the end of the day at 1629, and the markets went nowhere. The Russell 2000 down a little bit, the NASDAQ flat, the S&P 500 index flat. Very befuddling to me because in my mind I'm like, well, it's October 1st. Here is the beginning of the volatility, and it just didn't happen. So I want to try to maybe take advantage of the fact that the marketplace is downgrading this event, and maybe we will see some volatility as we head into the end of the month. So we're going to use the VIX, the VIX, the options that trade on it, and we're going to look at the normal monthly expiration, and we're going to do a butterfly. Yeah, go figure, right? That's one of my favorite strategies, and we're going to make it an open wing butterfly. So, to set that up, we're going to look at the October 22nd expiration, which is the normal monthly expiration in the VIX. So if we're going to trade VIX options, we need to know where the futures contract is for that expiration, because that really drives the prices in the VIX. And the future is now trading at $17.66. And like I said, the spot, or the VIX index, is at 16.29. So I'm going to look to buy the 15 strike call, sell 2 of the 20 strike calls, and buy 1 of the 22 strike calls. So this is a 1 by 2 by 1 open wing butterfly. The net debit is $1.65 or $165 per 1 by 2 by 1 open wing butterfly that is executed. And don't forget, you got to put in any fees that you might be charged to enter the trade. That will be your max risk on the trade. Now, it's an open wing butterfly because we stop short on the short spread. Any butterfly is made up of 2 spreads. There's one long spread and there's one short spread. You pay for the long spread and you receive a credit for the short spread. So in our instance, our long spread is from the 15 strike call up to the 20 strike call. And our short spread is from the 20 strike call up to the 22 strike call. So the fact that the short spread is only 2 points wide and the long spread is 5 points wide, it makes it an open wing butterfly, meaning that if the market blows through the 22 strike to the upside, this trade will still be profitable. We pay a little bit more up front for this butterfly than a standard butterfly, but there's a huge benefit in that the market could go, the VIX could skyrocket to 60, and this trade would still be profitable by that expiration date on October 22nd. Okay, so how does the open wing butterfly do that? Well, the long spread is 5 points, so that means the maximum we can get from that long spread is 5 points. The short spread is 2 points, so the maximum we could lose on the short spread is $2. So the maximum this thing can trade for is $3 above 22, the difference between the widths of the strikes of the spreads, and we're paying $1.65 for this. So anywhere above 22 at expiration, this open wing butterfly should trade for at least $3. and then minus the 165, that means we're up $1.35 on the trade. Now, the maximum that it could trade for is $5 if it went out right at 20, right at expiration. So 20 minus $1.65 means that our max upside would be $3.35, but you'd have to get really lucky. It would have to stop right at that 20 point. But the most interesting thing about this trade to me is that our break even is about where the market is at right now. So to figure out the break even, and there's only one of them in this butterfly because we stopped short and made it an open wing, you take the 15 strike, the lowest strike, and you add in the net debit of $1.65. So that means that our break-even point at expiration of this trade is $16.65. So, if the market finishes anywhere above $16.65 on the expiration of our option contracts, we would be profitable on this trade. So, it's a very interesting way to get into a trade that will benefit if we see more volatility, maybe caused by the government shutdown, but who knows? Right now the marketplace doesn't believe that it's going to last long. That could be the only explanation that really solidifies why the markets just really did nothing today. And I like doing a volatile trade going into October, and this kind of created that opportunity. So I like our 1x2x1 open wing butterfly for a net debit of $1.65 or $165 per open wing butterfly that is established. Now, we recently did an open wing butterfly in gold, and I got to give a shout out to it. I'm not always going to review the trades that we've done previously, but back around the Fed meeting in the middle of September, we went out and did a open wing butterfly using puts on gold. And we did it on a Monday. The Fed spoke on a Wednesday, and by Friday, gold pegged right at the strike, at the middle strike of our butterfly. We use GLD, that is a spider that follows gold prices, and does a pretty good job of following those prices. And we bought the 345 strike put, sold 2 of the 339 strike puts, and then we stopped short on the downside and we bought the 337 strike puts. So gold, if you look at the chart, it kind of just hung around the 340 level, and then at expiration on that Friday, it actually closed at $339.18, 18 cents above our strike. So there would have been many opportunities to get out of that trade and be profitable. And here's a big difference between doing a butterfly in gold or an ETF that tracks gold prices like GLD, is that it's actually settled in the underlying. It's settled in GLD in 100 shares if you're just looking at one butterfly. Or, you could have, you could be assigned and exercise and actually trade the shares of stock. In the VIX index, it's a cash settled index, which the cash settled feature actually makes this less stressful, because I don't have to make sure I close that trade to make sure that I don't have a transaction in the stock. If you're positive cash, there's cash that goes into your account where there used to not be cash. And if you are negative cash, there's cash that's going to be removed from your account. And there's no trading of the underlying whatsoever. So I had to give a shout out to that trade. Very rarely do you do butterflies where it actually pegs right at the middle strike, right at the expiration date. But it happened, so it was worth mentioning. All right, well, that's it for this edition of Options Playbook Radio. Please click subscribe on whatever service you're using to listen to Options Playbook Radio. And if you'd like to learn more about all of these strategies, please go to optionsplaybook.com and check out all the education material that we have there. And until next time, thanks for tuning in.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.